the request for files, request for PPT, request for presentation, request for video, sir. Everything will be available to you by today, Sunday evening, or maximum by Monday. You will get everything, whatever has been done in last 2 days. So you please don't need to worry. We have busy resource persons. Sometimes it takes time for us to get the presentations from them or any files from them. So that is the only reason which may cause some delay. But definitely we are making an attempt that by Sunday evening or maximum by Monday, you have everything on your emails. Thank you.
Yes,
Sir, I think
and
it would
try to avoid the
perfect.
repetitive queries on the same thing. If your colleagues and your this is the other participant have asked a query, so that may not be required to be asked again and again. With this, I am believing you and giving and quite confident we will have a very enjoyable, very learning and happy learning experience, and we will try to learn this experience. Madam, you can officially start the session, then I will start.
Yes. A very good afternoon to all. I welcome you to this second session of the third day's certificate course on 7 days certificate course on IND AS. We have with us CA Manish Goyal, sir. He is a chartered accountant with an experience of over 2 decades and has been managing in accounting, finance, tax, and commercial functions in world's topmost MNCs and corporate houses in large and complex manufacturing setup across diverse industries from automobiles to pharmaceuticals, electricals, and EPC. Sir has received a number of awards and honors for achieving tough targets in various challenging situations. Sir has participated in key management leadership programs, including one by IIM Bangalore. CA Manish Goyal is a senior faculty of IND AS IFRS in the accounting standard boards of the Institute of Chartered Accountants of India. Sir is a technical reviewer in the Financial Reporting Review Board of the ICAI and is the visiting faculty in Sri Ram College of Commerce, University of Delhi for the Global MBA program. Sir is an active writer of professional blogs or articles on social media, and Sir is also a recognized IFRS by the Institute of Chartered Accountants of India. We welcome you, sir, and we are really thankful to you for accepting our invite to be the resource person for this particular session. Over to you now. Thank you, sir.
Yes, thank you, madam, for a nice introduction. And good afternoon to all of you, all the participants, my friends, all my learned friends. Right, it's a nice Sunday afternoon.
Sir, just one instruction. Sir, we'll just get, I just request all my team members to switch on the mobile. We want a click with you for the purpose of the report, sir. Just 1 minute and then we'll hand over the things
Okay.
to you, sir. Just to
Yes.
switch. I just request Charu and Pushottam, sir, to just switch on their videos. If anybody can do it, wants to do it, please.
Yeah. And put all of your mobiles on the mute so that it does not interfere in the communication medium of
Yes.
the class.
Yeah.
Shall I start, madam?
Sir, just a minute.
No problem. Take your time.
Okay, sir. Thank you. Thank you, sir. I'm sorry for the interruption.
No issue. So shall we
Thank you.
start now?
Yes, sir.
Okay. So what this is once again, friends, welcome to the today's session of IND AS. And today we will be covering two of the very commonly and very widely used accounting standards. First, we will cover the accounting standard IND AS 36, which is on impairment of assets. And then in the second part, we will cover the IND AS 105, which is basically non-current assets held for sale and discontinued operations. And as you know, these both the standards are quite frequently used in our day-to-day practical life. Either we are working in a company or associated with a company as an auditor, or consultant, and they have a most wide this is the implication both on the financial position as well as the profitability as well as the reporting and disclosures, right? So we need to understand these standards in detail in whatever professional capacity we are associated with the preparation and presentation of the financial accounts. So now coming back to the situation is that these account IND AS have been there for quite some time, and all of us must have read these standards number of times. But still, sometimes we feel lack of confidence, or sometimes we feel certain points, certain concepts are not so well clarified to us that we have to this is that always go for certain discussion classes and this thing. So my purpose is that is today you ask all your questions, all your queries, wherever you have the difficulty in applying in these standards in your respective professional positions. Plus, what is that today we will try to explore these standards in a little different way, more from the point of the practical applications and conceptual clarity. Because if we have that these two, conceptual clarity, practical application, and we don't need to run after the little technical or colorful language of the standard, because whatever times you read, you cannot retain the exact wording in your mind, right? So then, but if we have the complete clarity of the concept and the practical application, this is that knowledge, then we can develop our own very own personal, easy, this is the communication language, right, to apply it and can retain it for a longer time and can explain the standard to any of our professional colleagues. So with this note, let's start and welcome all of you to today's session. Now, let's first discuss IND AS 36, impairment of the assets. Now, let us first understand, as we said, we will more deal with the conceptual clarity and the practical application. Theory is automatically will follow. Now, what is impairment of an assets? Let's try to understand. Impairment of assets, we all agree, will be reduction in the value of assets. That is the most common term. Then, and where value of an asset, what is the value of an asset? Value of asset means carrying value of the asset in the balance sheet, right? And then what should be the reduction in the value of assets, or when there should be a reduction in the value of assets? When there is a reduction in the carrying value of an assets in the balance sheet. So that is fine up to here. Now suppose, let's start straight away with conceptual clarity. Now suppose there is a machine, right, an item of PPE in the balance sheet of X Limited, whose carrying value in the balance sheet is rupees 6 lakh, right? And then how the carrying value of this machine can be reduced, right? Okay. So what are your answers? Very quick answers. So I want a couple of quick answers, because you feel that you are participating in the standard in this session, and most of the times in the case studies, right, you have to deal with the this is that practical situation. So then it will increase your practical this is that clarity and the application confidence. Okay, so let's see what are the answers. Okay, depreciation, mishappening, technical obsolescence, change in, okay, right. So, okay, okay, sale, change in technology. Okay, I got this thing. But let us see the right answer, and then let us try to clarify our knowledge and concept. So whatever friends you have given the various answer, good, very good. I'm very happy that you are participating and you are giving responding. But most of this thing, either the change in technology, accumulated depreciation, right? Then is the basically is the indicators, right? That it is that the reasons. But more accurately, before defining the reduction in value of assets, don't we need to understand what is the carrying value of the assets more clearly, right? So let's see that. Now, can we say carrying value of an asset is the recoverable value of the asset of the balance sheet? Ultimately, if the machine is this is if a machine is having appearing in the balance sheet of a company at 6 lakh rupees, that means is that machine's estimated value, right? This is the is the rupees 6 lakhs. That means this is the company is expecting to recover a value of rupees 6 lakh from the machine. So that is a recoverable value, right? So the what is the answer? Yes, no, right? Quickly, okay. Let's see the right answer. Yes, because carrying value is what? Carrying value is the recoverable value. We will see that. Just hold that thing. How we will say it is recoverable value. Now, this means if the carrying value of an asset in the balance sheet is the recoverable value of that asset in the balance sheet, then that means the carrying value of this asset will be reduced if there is a reduction in the recoverable value of this asset. Yes, right? Obviously, correct? Okay. So now this means that this is the reduction is that means that the reduction in the that value, carrying value and assets will happen only when the recoverable value is the less than the carrying value of the assets, right? That means the asset is carrying more than the value it is able to deliver. It is that is the entity asset is carrying in the books of the entity, which more than the value which is capable to deliver. Correct? Now, so what is the recoverable value? Now, an asset. So see, you can recover the value of an asset by only two ways, right? What are these two ways? Either you use that assets in the business. That is one way of recovering the value of an asset. Correct? Then second is the when you can sell the assets in the open market. These are the only two ways, right? Dr. Anjali, few of the candidates are reporting some audio issue. So just you please see whether it is on their part or it is on our part. So
So your audio is clearly audible,
yeah,
and participants are requested to kindly check the network connectivity because clearly it is everything is clear, sir.
okay. Thank you very much. So now coming back to the rhythm is that so that we are very clear now, right? With this introduction is that is you can recover the value of an asset only by two ways, right? One is that either you can use the assets into the business, your respective business, for producing the goods and services, clear? Or you can sell if you feel that the assets is not capable of producing the goods and services of a quality value, or this is that it is some of the reasons which you have explained. That is the new technology has come and all, so that they can recover the whatever the best value that asset is capable to provide by selling the same in the market at the market value. It's nothing but the fair value, right? In old this is the gap we were knowing it is as a net realizable value recover this one, and in the new assets it is says as fair value less cost. Now in both the way, let us see if there is a if the business, if the company sees that it is more useful to use the assets in the business, then the as what will be the recoverable value, what will be the result? The asset will generate the future cash flow. asset will produce the goods and services, goods and services will be sold and to produce the future cash flow. So the recoverable value in the usage method will be nothing but the present value of future cash flow plus residual value and minus cost to sell, and that is called the value in use. Yes, so that is the thing, and that is what is the cash flow method of calculating the discounted cash flow method of calculating the recoverable value. This we are very clear. We have been using this method since a long time earlier also was there, but now it is there. Little bit few modifications which we will discuss very clearly. So the concept is fully clarified. Now, if the entity sees that there is no much benefit, right, in using the assets in the business, then what is the next option available to the entity? Sell it off, right? So the assets can be can be sold, right, in the open market, and then whatever is the best value and what is the fair value in that this is that there we can sell it in the open market, and in that manner, what is the recoverable value? Fair value minus CTS means cost to sell. That is whatever is that fair value on the date of sale, and then what is the expenditure in selling the same is that our recoverable value, because we are calculating why fair value, because we are calculating the estimated fair value, estimated recoverable amount, right? We are right now is not actually selling it. We are, that is a concept. Those who have attended that have clarity on the fair valuation, they would have immediately got the point which I am trying to say. Okay. Now there are two types of recoverable values are available. One is by usage method, one is by sale method. Now, what should be our final recoverable value? You will definitely ask a question that what should be our final recoverable value? We have two choices. So naturally, think, apply the logic. Everything is very logical, nothing theoretical. So naturally, as a businessman, if it's my company, right, which value I should go as a recoverable value? Naturally, which option will give me a better value, higher value? Correct. If I see a recoverable value by using the asset is more, I will go for that. But if I feel that this is recoverable by value by selling the assets in the market is more, I will go for that. So that is why it says higher of the two, right? Okay, the higher of the two is the final recoverable value. That is recoverable value by usage method or recoverable value by sale method, right? So therefore, now can we say impairment of an asset arise when the recoverable value is less than the carrying value, because your assets are stated in the balance sheet at a high, little inflated manner, inflated value more than the value which they are capable to deliver. That is an overvaluation, and we know the purpose of preparing and presentation of financial account. So is the true and fair view where, and we always certify that assets are shown in the balance sheet at their recoverable value. You go through the accounting policy notes of any company. This is the most common and for most important first confirmation by the management as well as by the auditors of that company also, that assets are this is that carried, presented in the balance sheet at their fair value, at their recoverable value, right? So that's the concept. Okay. Now, let's have a case study on this, right? Somebody was asking Sunil Kumar, right? So Sunil, your this is that request is accepted. Here is the question, and then please let us see how you resolve it. Now, let us see. Let's continue that case study which we are trying to build. So we have seen that X Limited started the discussion that X Limited is this is having a machine as on 31st as 1st April machine as on, which is the whose carrying value is as on 31st March 2020 was 6 lakh, right? Naturally. So now let's develop this study. And then you all try to resolve as if this is the, there is a professional request, there is a professional assignment has come to you. Let's try to solve it. So X Limited purchased a machine with a useful life of 5 years, correct? As on first this April 2019, right? So for 10 lakhs, so that there is a depreciation, and then and if there is a 5-year useful life, then 2 lakh is the yearly depreciation, right? So the first depreciation will be I think there is a little bit mistake. It should be 18, first of April 18. So the first depreciation will be 31st March 2019, 2 lakh, and then the second closing date will be 31st March 2020, and straight line method also both. That's what Anuj, I have already said. It's a please take it as 2018, right? You are correct. Then is the, so that final carrying value is the is as on 31st March 2020 is 6 lakh. Now at this 2020, you know, that is that after in March pandemic broke out, right? And we are aware, right? All the companies are, it is evaluating the impact and the impairment impact, because there is a complete scenario change. There is a complete fall of the production, complete downfall in the sales, and there is a huge impact. Is the this is the, there is a huge impact on the future cash flows. Now it is now this is a situation. Let's see that. Now, on 31st March 2020, it is noted that a new high-tech version is launched recently, which is 2 times faster than the old machine. Okay, good. Market value of old machine definitely will go down, right? And because, and then hence the company obtained, tried to, this is do some the impairment decision making, then they have obtained a market value which is assessed at 5 lakh. Okay, right. So now is that what will be the impairment loss? Right. Answer is in front of you, but this is can you relate the situation? Machine carrying value of the machine is 6 lakh rupees, right? Okay. Then Kumar Srinivas Rao, good, right? And Deepika Bansal, you have to little bit, because impairment indicators and all we are going to cover in a couple of minutes ahead, right? So have little wait. Now, so naturally, that means what is machines recoverable value, real worth value, market value or recoverable value is 5 lakh, whereas we are showing the same machine as 6 lakhs. That is not a right method. That is not a right accounting. Naturally, we have to reduce the value of the assets. There is a reduction in the carrying value of the assets, right? It is an overvalue, shown at overvalued price. So therefore, the real worth we have to reduce the carrying value of this machine to its real value, real recoverable value. But if we do that, that will be this is which is 5 lakh. So 1 lakh will be the impairment loss. Correct? Are you following it? Right? Arvinda, it is right. Okay. Yeah. Rakesh, I will answer your question shortly. Now, then, okay. So what is the accounting treatment of this impairment loss? Now we see my machine is more overvalued, and it is shown at an overvalue price of 1 lakh. So I have to reduce it down to the recoverable value to continue to make keep my accounting and as well as the financial statement true at true and fair view. Right? Okay. The entry will be, it is given very boldly in your screen. Impairment loss debit, right? P&L naturally, and we will see. This is that little bit more discussion on the this going to the P&L. Then impairment loss naturally immediately as per the standard it will go to it is to be gone to P&L. Okay. Then two accumulated debt impairment loss or provision for impairment is a balance sheet account. So you are keeping all your impairment losses over the years into this account, correct? And that account, balance of that account will be deducted from the cost of the assets in the fixed asset schedule in the balance sheet, right? Just as in case of the debtors, right? Debtors, then provision for doubtful debts, and the final figure is carried on. The final value is carried in the output of the balance sheet. Same here, P&L impairment losses we know conservatively, right? As per the prudence concept, the losses is to be recognized immediately, right? As a this is that as if they have realized. So that is why we go to P&L. But gains not. That is what the OCI concept has come. The gains, this is the unrealized gains are going to OCI, but losses are, as per the prudence concept, always go to P&L, right? That is one. Impairment, whatever the losses are there over the period of time, we keep on accumulating in a separate balance sheet account, and that will be deducted, right? It is this is the from the final value of the assets, right, in the balance sheet. And this is Sampath, you little wait. I will give you all clarity, but little you have to wait for a few minutes, right? Okay. Now, so that is what it says, is that if I minimize the chat box, is now the another important point, which is you have to note it here, friends, is that impairment of the asset is the reduction in the value of asset in addition to depreciation. I think you must have followed from these case studies. Depreciation will carry on as usual, right? Correct. Impairment is the, it is not, depreciation is not the loss. It cannot be taken as a loss in the value of assets, right? So depreciation, they say impairment is the loss in addition to the depreciation, right? So this is the point you need to note it down, and then, okay. Correct. Now, continuing the case study further, if it, let's say, the company has obtained the market value, but right in the meantime, that is and now auditor asked, because now they have the data, they have the indicator that the market value has gone down and the recoverable value has gone down. This is carrying value. The auditor asked to do a proper impairment testing, right? For that, they need to get a this is that value in use, right? So that, but in the meantime, development company received a farm sale order at a good price, right? It calculated that the PV, present value of future cash flows from the machine, right, at the current IRR, right? IRR is the expected rate of return. It is coming at 6.25 lakh. Now, what will be the result of this impairment testing? Now you have both the recoverable value. Little bit quickly, because time is running at a faster speed. So within 1 second, 1 minute, you can find out the answer very easy, and then we will compare the right answer. So now there is a market value, fair value is 5 lakh. Cash flow value in use is 6.25 lakhs. So what should be the recoverable value? That means higher of the two, naturally 6.25 lakhs. So what will be the result of this impairment testing? Right, 6.25 lakh. So no impairment is required. Right, my recoverable value is more than the carrying value. The no impairment is required. But suppose the value in use would be coming 5.5 lakh, then what? Then that is the, in that case, that is the recoverable value will be 5.5 lakh. Then in that case, you have to book the impairment loss of 50,000, right? 6 lakh carrying value, recoverable value 5.5 lakh, which is higher of the two, and that is the 50 lakhs accounting treatment we have already seen, right? So the concept is very much clear. Now, with this way, like this is, we can retain this concept till a long time, and we should not have any problem in the future application. So now come to the recognition and presentation. Correct? Entry, I am just repeating so that you have the complete clarity on the entry side. Now, we know that is an asset, either tangible assets or intangible assets. Both can be valued by two ways, right? Either by cost method, cost model, or by revaluation model. Couple of the people were trying, I was seeing the chat box, they were asking what is the difference between impairment and revaluation. They should get a clarity. Otherwise, we will discuss in the question answer session. Now, they should focus, they will get the answer now. Correct? So, cost model means the asset will continue to value in initial as well as the subsequent measurement, and on every subsequent balance sheet at the cost, right? Cost less depreciation, less impairment, then again cost carried forward, cost less depreciation of the year, and impairment loss, if any, and then the balance will be continued to forward. We already know impairment loss is a additional reduction in the value of assets over and above depreciation. So these two are separate, right? Okay. Now, is so in case of cost model, there cannot be any revaluation loss or revaluation gain because the asset continue to be valued year on cost method. So, if there is an impairment loss and the asset is following, asset is being valued on in cost model, then impairment loss we have seen will go directly to P&L account. Correct. But what about if the asset is valued in by following the revaluation model, right? Now this is the point that you people are maybe willing to ask. So please see. In case of if the company is following the revaluation model of this is that for the valuation of the asset of a particular asset, and that asset we are doing the impairment testing, and on impairment testing of that asset we find, right, that there is a impairment loss. Now, so shall we should also straight away take it to the P&L, or we should think? No, correct. We should think here. We have to stop it. Give a pause here, because the company is following a revaluation model. There might be some revaluation gain happened on that asset in the past, right? And where we will find that revaluation gain? I have already given you the hint, OCI, right? So some of the revaluation gain of the past on that asset might still be carrying on your balance sheet, and where those gains surplus in the OCI, in the carried forward balance of OCI, in the name of revaluation surplus in the other equity in the balance sheet, right? Under the OCI, this is the heading. Now, in that situation, if there is a already a this is that revaluation surplus on that asset is still, right, there in your balance sheet, then we have to be, as a matter of prudence, we have to first set off the impairment loss, current impairment loss on the current closing date, balance sheet date, with the existing impairment surplus. Otherwise, there is no point in showing the inflated liability, inflated asset. Right? So there is we are showing the loss also, or on the same assets, right? On the same assets, we are showing the profit also. In the revaluation surplus, we are showing a loss also under the impairment loss. So that is not there, and we know as per the accounting concept, the profit and loss of a single assets, right, has to be net off, and the net profit and loss has to be shown. So that is that impact. The revaluation loss has to be first set off to the extent any past surplus profit is available on that assets, and balance impairment loss shall be transferred to profit and loss, right? So that is the answer you must have got, right? So revaluation model is what? Is a year on year regular year. This is the valuation, right? This is that as per the normal accounting practice. And what is impairment? What is the difference with impairment? Impairment is event based, right? So we will see what are those events. Even impairment is additional loss, or this is that loss in the value on the happening of certain specified events which we call impairment indicators, right? So it is not automatic. If there are no indicator, we don't do the impairment testing. Impairment testing, right, is to be made only on the happening or non-happening of certain events, right? So that is what now all the chat box answers relating to this point must have been got answer, must have been answered that impairment testing is to be an entity shall make the impairment testing only when there are impairment indicators or right, or when the asset required annual impairment testing. So that means what the standard is giving you a hint. What is the right position? That impairment testing has to be done only and only in two cases. One is that when there are some indicators, when there are certain the events happen, or otherwise when in certain situation is that we have to do the annual impairment testing. But in revaluation is a independent process, that is a annual this is that kind of a like a annual this is the appreciation process, and that is how that is the annual process, annual measurement process, and the closing process, right? That instead of cost you are showing the assets on the market value year on year, right? So that's a annual accounting exercise. But impairment is a separate one which happen only and only when certain conditions happen, prevail, right? So now there are two types of indicators, right? One is internal indicators, and this is the and one maybe the external indicator, correct? So let's see what are the various external indicators first before coming to the internal, right? Okay, so external indicators are what? Right? There are four external indicators which have been defined by the standard, right? The first one is that the assets market value has declined significantly, and the word is more than that, more than expected as a result of passage of time or normal usage. That is, as it is in addition to, let's again it is saying over and above depreciation. The more than expected as a result of passage of time and normal use is normal depreciation. So, but there is a fall in the market value of the assets over and above the normal depreciation. Best example currently going on, right? What happened in the automobile sales, right? Automobile market, there was zero sale in the month of April 20, right? And this was first time in the probably in the history of automobile, not even a single car was sold, right? That is the situation. So in that situation, you have to do the impairment testing, because if your sales, if your market value of the asset has declined significantly, then what it is showing? Decline in the recoverable value, right? Both way, either by way of usage method, value in use, or by the cash flow method, sale method, right? This is the fair value minus cost to sell. So in that case, you definitely have to do the impairment testing. And all the companies now June 1 result you are seeing, correct? Indian economy has contracted how much? 23.9%. Manufacturing sector has gone down by around 38 to 40%. So every company like has to see that what this is, do the impairment testing more or less, see whether their assets are still showing at the recoverable value. So this is the one of the first most important indicator. And let's quickly see the other indicators. Significant changes have taken place during the period in the technological market, economical, legal environment. And third is the market interest rate. Now, this is the second changes. Many of the initially, when we started the lecture, people have given a lot of enthusiastic reply, right? Year and year, change in technology, all these things. Now they are able to better relate, right? That they are the indicators. They they indicate the company should do the impairment testing in those conditions. So the examples are given, like the best example LED replace CTVs, LCD replace CTVs, then LED replace LCDs. Now there are more and more high versions of the ultra high definition, and those kinds of TVs are coming. Electric vehicles will replace the going to replace that is normal ICE vehicles. So these are the situations that standard says in those conditions you should definitely do the impairment testing. Market rate, market interest goes up, right? When what will happen if the market rate goes up, discount rate goes up, the same cash flow, right, will give a lower present value of the future cash flows, right? And then that will be the impairment that will result into the impairment, because that will reduce the carrying recoverable value, and carrying value may be more than the recoverable value. Now, the best example, if you are able to relate, is what is the best one is that 2018 NBFC crisis. You remember ILFS crash, 90,000 worth of balance sheet gone off in a single day, right? 90,000 crore rupees, right? In the NBFC, which is the basically all these infra companies and all these companies are which are called basically the shadow bankers, and they are the one of the most important source of finance, right, to the industry. They crashed, all NBFC crashed, which are still not able to recover till now, right? So what was happened is that they completely chopped the flow of credit to the infra and construction sector, and then the market rates, interest rate shoot up, cash flow value go down, recoverable value go down, impairment. So these are the indicators, and then next is the carrying value of the net asset entity is more than the this one the market capitalization, right? So if the market capitalization is lower, then like now suppose you have a subsidiary, but market value of the subsidiary is this is the less than the your carrying value in the consolidated financial statement of that subsidiary as a subsidiary investment, impairment, because market as per market you, that is your subsidiary, your asset is not able to deliver that much value. And there are internal indications like obsolescence, physical damage, right, significant change, then adverse impact on the entity, right, are expected to happen on near future, right? So like assets become idle, like we have seen, and discontinued operations. In those cases also, your market value will go down. There are indicators that you should go for the impairment test. Now, and then another indicator is that internal reporting provide in there are evidence, right, that economic performance of the asset is goes down. That means actual cash flows or operating profit is flowing from the assets are more than the this is that less than the budget. You feel that assets will give the product which will be able to fetch X number of X amount of rupees profit per unit, but cost of producing that product from that machine is much more than, and you are getting a lower profit. So that is an internal indicator that machine has to be tested for impairment. Correct. So they say the list of indicators is not exist. It is only indicative and not exhaustive. But if those kind of indicators happen, then you should go for the impairment testing. And now many people were trying to ask the question, when annual, they have the doubt of the annual impairment testing. So I am going to clarify, friends, please note that annual impairment testing is to be done only and only in 3 cases. This is a most important doubt which the people keep on asking. Very, very senior members sometimes also having this kind of doubt. Correct. That is okay. When an asset has to be done, go for annual impairment testing. So please clarify. Today onwards, there should not be any doubt. Annual impairment testing is to be done only and only in 3 conditions. One is that intangible assets with indefinite useful life, and in case of intangible assets not yet available for use, and goodwill acquired in a business combination. So one is goodwill and 2 are related to intangible assets. Otherwise that no annual impairment testing is to be done. in any assets, in case of any assets, and that the regular impairment in testing is to be done when there are either internal indicator or there are external indicators. Point clear? And still, if some of you has any doubt, just wait for some time. In the question answer session, we can address all your points. Right? So I think now the concept is getting clear and clear, and your question automatically will be minimized. That is my belief. So that is now, after understanding this, now can you say, can you have little better confidence that now you can understand the theory in a much better way? Okay? Because theory is saying you can develop your own personal, this is the language, to explain the theory. Same thing are said, objective to ensure assets are carried at their recoverable value. That standard says we have understand, now we have understood why, and we have shown, we have also understood how it is to be done. Correct? And then they are also saying that the IND AS is not applicable, and we know that wherever there is a principal IND AS applicable to a issue or to an item, the other IND AS does not interfere in the this is the applicability of that standard, right? So that is why where there is a one master IND AS, one full IND AS is dealing with a particular subject in detail, the IND AS 36 does not interfere, right? Each standard has the full freedom, full command on its area. So inventories, deferred tax assets, assets arising from employee benefit, financial assets, biological assets, deferred acquisition cost, insurance contract basically, and non-current assets or disposable group. So IND AS is not applicable to these items because their treatment, their recognition, their measurement, and their disclosure. That is what the role of the all IND AS. What is that? This is the first is that recognition, right? Second is that measurement, initial, subsequent, and the disclosure. So all these 3 points are covered by their respective standards, right? So IND AS 36 does not interfere in the same. So that is the scope, non-applicability. But there is a applicability which is a change. Please note down that this is a major difference. The earlier is the this is accounting standard, basically Indian accounting standard, yes, right? It was not dealing with not applicable to this kind of assets, but the new IND AS deals with the subsidiaries, associates, and joint ventures also, and their impairment indicators are also given. That is, now see, consider a situation that you have a subsidiary and you are flexing your muscle and you are taking more dividend than the income, then what you are making? You are making the subsidiary as bankrupt over a period of time. It will have continuous this is the losses over the time and that reduction in the capital. And after that, beyond a time, it will not be able to this is that deliver the value, and that valuation of the assets will be performance of the assets, production of the assets, the capital will go down, and then this is that it will start running into losses, and then over a period of time, right, the losses will be, and the complete net worth will be eroded. So it is what? It is an impairment indicators. You are definitely in coming 1 or 2 years, right? In this is you are definitely have the to take the impairment. Or otherwise, like second example we have already covered, that in the that is you have a subsidiary, you are showing the carrying value, right? This is that of that subsidiary in your investment in your balance sheet, consolidated balance sheet. That value, right? If the market value is lower than the value you are representing, that in valuing your subsidiary, then it's a basically impairment indicator. Now, so I think up to here everybody is clear, right? Okay. Now let us say is the so we have seen the how everything about impairment of an asset, right? Now let us see the impairment of a group of assets. A group of assets is what? Cash generating unit. Correct. Now we know that recoverable value is what? Recoverable value is Surinder Gujral. I have seen, noticed your hands. Let us wait for another 5 minutes, and then we can now going to come in the question answer session, and then you can discuss all your questions. Right? Okay. So now recoverable value is what? Higher of the value in use and the fair value minus CTS. Correct? Value in use is what? Is the present value of future cash flows, right? Basically, it depends, and the residual value minus cost to sell. And then, if suppose the future cash flows of the individual assets are not available independently, then their recoverable value cannot be calculated. And in that, the recoverable value cannot be future cash flow cannot be calculated, then recoverable value cannot be calculated. And in that case, how to calculate the recoverable value? So nothing to worry, right? Standard has given a way that combine you combine related assets and keep on combining the assets till the time that group of assets, right, is you can calculate the cash flow of the group of assets, right? What is the best example? Correct? Can you give that example? One example to me, right? See, but that is like suppose in a plant, in a factory, correct? You have that is three production department, right? Stamping, then welding, then painting, then assembly, and then testing. Like five. So, can you calculate the cash flow of painting department independently? Can you calculate the cash flow of this is the stamping department, welding department independently? No, we cannot calculate, and that is why we have to calculate the cash flow. If at all, we have to calculate the cash flow of total plant, right? That is required. All that five production units together. Then that is in that case that this is the complete plant is to be taken as a CGU, cash generating unit, because it consists of various this is the assets, right, and their associated current assets and current liabilities, so that they as a group they are capable to generate the cash flow, but as a individual assets not. So that is the concept of CGU. And for impairment there is no difference. The impairment of the CGU is also to be done in the same way, right, as the impairment of individual assets is done, right? Their carrying value of the CGU is compared with the recoverable value of the CGU, and if the carrying value is higher than the recoverable value, difference is the what? Is the impairment loss, journal entry, accounting treatment, presentation, everything remain the same, and but only one difference. Only one difference. Friends, please focus, because if you divert your attention in raising some smaller question or smaller doubt, you will may miss the bigger points. Those smaller and doubts, I am giving you the full confidence. I will not go unless I answer all your questions. So please do not worry about the smaller doubts. Try to consider the bigger concepts and those smaller points. Anyway, not going anywhere. We are going to clarify in the question answer session, right? So that is my suggestion. So what is the difference between the how to deal with the impairment loss? Impairment loss, same way. The only thing is that we can, the difference is that is the impairment loss, because CGU is a group of assets, right? Impairment loss is for the group of assets. We have to allocate the impairment loss to the respective assets. How we allocate that loss to the respective assets? By allocating the same in the carrying value. If the total value of CGU, if cash generating unit is 1 lakh, right, and there are four assets, 20 for 25,000 each, right, carrying value, then, right, the impairment, this is that loss is 1 lakh. So then divide the impairment loss in the carrying value 25,000 each to all of the four assets. So that's the very simple. Now let's do the another case study quickly. is that very interesting case study that will clarify you the complete concept of the CGU. Please focus it. Keep noting down your question, because if we start taking up the question, we do not have that much liberty of the time, right? We can very well take, and I am the most happy person to take each question and then proceed further. But sorry, because we have the time limitation, so we have to do it, complete the session, and then we will take the question, right? Hope you understand. Now, this is there is a X limited. Please read the question very carefully. If there is a case study, the question X limited is making sheet metal product. In this case, the company has three production departments: cutting, welding, and painting. Since the cash flow of individual shops cannot be calculated, entire production line is to be considered CTU. That we are very clear now, right? Okay. Now, the X Limited gives the following estimates of cash flows relating to production line in as of 31st March 2020. The rate of discounting applicable to this kind of assets, right? Discounting rate, it means it's saying the discounting rate applicable to the production department is 15%, right? Like saying the IRR. Okay. Now, the plant important data, note down the important data. The plant equipment was purchased on date of purchase was 1st April 2017, and historical purchase cost was 12 lakhs, right? Out of which individual cost of welding painting shops were 3 lakh cost of cutting shop, 4 lakh cost of welding shop, 5 lakh cost of the painting shop, correct? 3 plus 4 plus 5, 12 lakh. Total plant was set up 12 lakh rupees, right? 3 years back in 2017 at a cost of 12 lakh. The useful life of the plant is 8 years, right? Okay. Residual value after the end of 8 years will be some amount, but the present value of that is already given. Why? We could have, otherwise we would have wasted the time in calculating the present value. That time is not available with us. So I am making a little bit easier the case study. That present value of the residual value, which that is after 8 years, whose present value at present, right? We are calculating the impairment today is closing date to 31st March 2020 is 20,000. Fair value less cost to disposal as on 31st to March 2020 6.5 lakhs. So fair value, that is recoverable value by market method, by selling method is given 6,50,000. One of the recoverable value already given. Now, in March 2020, COVID happened, right? Then lockout happened. Demand of the company has gone down significantly. Hence, the company has decided. Now it's an indicator. We have seen it is a very valid indicator. The company has to do the impairment testing. One value is already they have calculated the market value. They have already assisted fair value 6.5 lakh. Now they need the second valuation, second method, fair of this is the recoverable value by second method. What is that? Value in use. Now, as to calculate that, the present value of the future cash flows is counted at applicable rate 15% for next 5 years. Please note down 1.1 lakh, 1.2 lakh, 1.3 lakh, 1.4 lakh, 1 lakh. Because in the 5 years, the first the machine cash flows will go up, reach optimum level, and then because of that, this is competition and the obsolescence, demand saturation, it will come down. So if here it is 1 lakh. Now, how to calculate the impairment loss of this CGU and allocate to individual items of the CGU, individual assets of the CGU. That is the most interesting question, case study. Please show that, or I am giving a pause, maybe 1 or 2 minutes. You can see that exactly 1 minute later, we will show the right answer, and then you can match that. In the meantime, let me read the chat box if I can answer some of your points. Yes, real B. If incremental borrowing rate change, right, and it is affecting your discounting rate, correct, then it can have the impairment impact, correct? Okay. Pankaj Jain, ECL is not applicable. That is basically is that financial instrument, right? And then recoverable, okay. Sapna Gupta recoverable 6.5. Are you sure, Sapna? Okay, let's see. So let's see the right answer, and then let's try to match our understanding how we come so far. Entire production line is CGU. Carrying value of the CGU will be calculated after accumulated depreciation and accumulated impairment loss up to 31st March. So the purchase cost was 12 lakh, right? Useful life 8 lakhs, sorry, 8 years. Accumulated depreciation from 17 to 20, 3 years, right? Divided by 8 into 3, right? 4.5 lakhs. So now we have the carrying value as on 31st March 2020, right? It is cutting shop 1,87,500, 250 welding, and 3,12,50, 12 lakh 500 painting, and total CGU 7.5 lakh. Correct. 100%. Anup Singhal, very good. No, that is a carrying value, right? But what is the impairment value? Friends, if anybody has not understood this case study up to this point, quickly write in the chat box, because I am unable to go to the question answer session. That will take a lot of time. But up to here, I believe it is given in such a simple presentation that everybody should be able to do, right? So carrying value, okay, okay. Sachin Jain, you are very near. Good. Yes, Sachin Jain, good. Sachin Goyal, sorry. Okay. No, Sandeep, 20,000 not to be ignored. Correct, na? Present value of present value of future cash flows plus present value of residual value. That is also a cash flow, na? You know, and minus cost to sell. Right. Okay. 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 So let's see. So now you can all see and find the answer of all your queries. Right. Please see. And then ask me if there is any. Now, you see, carrying value we have already taken. There is nothing, right? No change. Carrying value we have calculated, which is nothing but purchase cost minus 3-year depreciation is the carrying value as on today. I am sitting at 31st March 2020. We are doing, right, as if we are doing the work on closing date. So at the closing date, this is the value that I have taken. Same here, no change. Now we have to calculate the recoverable value to get the impairment testing. Impairment testing is what? Comparison of carrying value with recoverable value. Very simple. Recoverable value, carrying value we have calculated. We have to calculate recoverable value. Recoverable value, two methods. We can calculate by two methods. One is the market selling method, market value method, which is already given. This is the fair value less cost to sell. Net realizable value as per the old language is this is that 6.5 lakhs. What value in use we have to calculate? Value in use is what? Present value of the future cash flows. Present value of the future cash flows is already given 1 lakh, 110, 1 lakh 20, 30, 40, and residual value. Correct? Deepika Bansal, you got the answer now? Correct? Right? So, residual value considered. Some of the people were participants were thinking why it is considered, why is not considered. 100% it will go for the logic. Nothing is there. Nothing is arbitrary. Okay. So now the value in use will be what? And there is no cost to sell. So we don't have to deduct. So we have to add 620. Correct. And what is the residual value? Anybody has a doubt? Bullet speed, right? Higher of the two. Higher of the two is 6.5 lakh. So carrying value is 7.5. Recoverable value is what? Is the 6.5. And impairment loss is 1 lakh. Correct. Anybody, right? Some people were saying, please explain, please explain. It is clear, right? Correct. Ashish, Preeti, clear. Pankaj, good. Everybody is saying. Anybody who is not clear, right? Please just wait for a few minutes. And my apology. And then we will answer, right? I am not going to going anywhere unless your doubts are clear, right? Okay. Good. The people are clear. So if you people more write in the quickly chat box, so I am happy. I will feel happy that you are able to get the concept, and that is the what my best proof of my result effort, right? Okay. Hina, Goyal, Rajesh. Good. So at least right. Okay. Devinder Kurana. Okay. Anuj. Okay. Good. Then sorry, Jashan Kumar Setia, please, I am not able to take off the hands, right? So we will do it a little later, right? Please hold your question. Now, next question, next important. How do we, which is the basic concept? If we understand, whole standard is clear, finish. We don't need to go for the colorful language, technical language, and breaking your head. Impairment is over, right? It's simple, very simple. Now, let us see how this impairment loss, if there is a single asset, we know it very clearly. Impairment loss debit to the provision for impairment loss go to the P&L account, provision for impairment will be deducted from the carrying value. Asset in the balance sheet. Simple. If there is a cost model, no problem. If there is a revaluation model, just check here. What is the issue? Nothing issue. Just we have to see our balance sheet. At least that we can do that much. Just go to your balance sheet, see if there is a revaluation surplus available for that asset. First, net it off, balance transfer to PM. Finish, right? But now this is Sandeep. Sandeep Sharma. I don't understand your question, boss. You reframe your question, right? I'm not able to understand your question. I will reply in the question answer session. Okay. Now, is that how to deal with the impairment loss, how to account the impairment loss in a CGU when there are more than one assets, group of assets. Okay, basic principle remain the same. Okay, now it says that what we have done, can quickly some write on the chat box. What was the principle? The principle was that impairment loss will be divided into the various assets in the group of assets like CGU, right? In the ratio of their carrying value. 100%, right? Agrima, right? This complete answer with the bullet speed. 100% right. Completely balanced. CV ratio, carrying value ratio. That's what we have done. So we have the carrying value of all the three departments, right? Then 1 lakh is to be divided into the three in their carrying value. That's what we have done, right? Devendra Khurana very well, proportionately on carrying value, 100%, right? Then matter is over, impairment loss is allotted, accounting treatment remain the same, right? And now another small, very small point is that once you have done, now you have the revised carrying value. Revised carrying value is 162, 2,16,000, 270,000, total to 6,50,000. Then this revised carrying value, we have read the old accounting standard on fixed assets and the new PPE number of times, that the revised carrying value will be, this is that will be depreciated over the residual useful life. Devendra Khurana, excellent. Right. So 3 years have already done. There is nothing told which is in fact is given. It says that my life is reduced, my value is reduced, boss. No problem, because the market value has gone down because of the pandemic. But my assets quality does not degrade. My asset is very strong, right? So there is no threat to the life. The asset will work, will be 8 years, 3 years gone, 5 years then, and the revised depreciation will be well revised depreciable value, carrying value, final carrying value after impairment divided by the revised useful life, right? Correct. Pankaj, that is a good question, right? An estimate. Right. I am covering. If this is covered in the presentation, but for you, you have asked the question little early. It is a change in estimate, not it is the this one. So no restatement, not a change in accounting policy. It's a change in accounting estimate. Okay. Now, Mansi, not the right question. Maybe refine your question, please. Now, then three special situations is the impairment of corporate assets, impairment of goodwill, and impairment and reversal of impairment. Let's quickly see. Right. Yes, Dr. Ajagar may not be fully, but partially I will touch. And you can reach me after that session if you want to discuss in detail. Right. Then corporate assets. Now, what is corporate asset? Corporate asset is nothing but we are unnecessarily getting bothered. Corporate asset is a kind of a same thing like a CGU in a different form, but there are some basically principal difference, conceptual difference. If we clear that, everything will be cleared. Now, corporate assets are basically assets other than goodwill. Leave goodwill. Goodwill, you know, is always something different, different ball game, right? We will deal with it. Okay. Now, no, Himanshu, no. Residual value is benefit. Yeah, you will get some cash in, cash flow in. How you will reduce? Cash flow is that this is the cash coming in. It's cash coming in, right? Please. Okay. Now, then corporate assets are assets other than goodwill. Leave apart goodwill for the time. That contributes to the earnings. I am giving you very simple, common, our English, Indian language, Indian English, not the colorful English, right? Then that contribute to the earnings of future cash flow of the, this is the other CGUs, other cash generating units, other assets, right? For example, best example, it is applicable everywhere, every company is what? Building of HO, right? If it is not in the plant, right? If you have a separate head office, corporate office, registered office, or a separate, most of the companies have a separate research center, right? Toyota Research Center, Mahindra Research Center in Chennai, Renault Research Center in Chennai, Maruti may be having a development center in Gurgaon, right? So, or a separate EDP center, correct, which is providing support or facilities, right? This is to more than one department. It's not dedicated. And secondly, is that they don't earn any cash flow, right? They are not the earning department. They are not the selling department. They are not the earning cash flow earning department. So the distinctive characteristics is that two condition. It is that is why this green small part. Just remember very easily, right? Conceptual clarity. They do not generate cash flow independently, and their carrying amount cannot be fully attributed to cash CGUs under review. Right? This is that this is an accounts department, finance department, which we are related to. Can we say we will provide service to only one department? We are providing accounting. We are to the marketing also, productions also, HR also. IT department is giving services to everybody. So their value, their assets value cannot be attributed to a single asset or single generating unit. So that's if two conditions are satisfied, that is the corporate assets. Correct? Now, since corporate assets do not generate the separate cash flows, right? So they cannot be tested, correct, in individually, right? So then they have to be tested only and only with in relation to in the context of in the standard language used in context of what is in context of together in relation to with, right? So that it can that is corporate assets cannot be tested individually for impairment. Their impairment to be tested along mixing that asset together with some other CGUs, which for which, right, this is the separate cash flows are available that are right. And it is also not necessary that we are reviewing all the CGUs for testing, right? We may be using only one of the CGU for testing, impairment testing, because the indicators only for that indicators are only for that CGU, not for other CGU, right? So that is the thing. So that we will consider only the one CGU, and the value, total value of the corporate assets will be allocated to all the CGUs to which that assets are related to, or to whom that this corporate assets, those corporate assets are supporting you, right? And then let us say there are two plants, one head office building, 10 lakh, their value is allocated as per the carrying value 4 lakhs, 6 lakhs, right? And then we are testing the impairment of only one plant. So we will do the impairment testing of that corporate assets only for considering only the allocated amount, leaving apart the other. Right? So that is what it says. There may be two types of corporate assets. I've already given the example, and then there is case study. We have to cover it fast because otherwise we will be delaying the session. So corporate assets which can be allocated on a reasonable and consistent basis to other CGUs, right? This is under review to the CGU under review, one CGU or more than one CGU, or this cannot be so. And then if that the value of these corporate assets can be allocated to the CGUs under review, one CGU or more than one CGU, then allocate the same in the ratio of CGU, carrying value of CGU, then calculate CGU under review means that CGU which are for which you are doing the impairment testing, right, Sunil? Okay, then you allocate the carrying value of the corporate assets to all the CGUs which you are reviewing for impairment testing in the ratio of same principle, carrying value of CGU. Then calculate the impairment testing by comparing the carrying value of the CGU with the recoverable value of the CGU along with the allocated value of the corporate assets, right? And then whatever impairment loss is there, again distribute the same in the ratio of their carrying value, right? That is that loss relating to the carrying value of allocated carrying value of corporate asset will go to corporate asset. Balance loss will be allocated to CGU. CGU further in the ratio of the assets of the CGU in the ratio of carrying value. But if not, then that is a little bit complexity, but not very much. Then you calculate the impairment loss of all CGUs without considering the corporate assets in the first point of time, because you cannot allocate reasonably the amount to the CGUs which you are reviewing for the impairment testing. So you don't consider the this is their CGU corporate assets in the first point. So just calculate the impairment loss of the CGUs in the usual way, right? And then is after that what you do is that do the allocate the count the impairment loss, and if you if there is impairment, allocate the impairment loss, right, in the same way in the carrying value, and calculate the revised carrying value. And now once again calculate. See, there is a simple way of understanding. Standard says a different colorful language, that is that again calculate the impairment loss by considering the smallest group of assets, which are able to generate the cash flows independent from the other CGUs, which is what increase the size of your CGU, right? Correct. It is consider the larger CGUs. Consider the largest CGUs, so that who can allocate, who can this is the bear the allocation of the corporate assets, right? If your total carrying value of CGU itself is 3 lakh, and that is the carrying value of the corporate asset is 20 lakhs, allocation is coming 5 lakh, then how you allocate? No, right? So it's basically is the you have to increase the size of yours. That's what I'm saying. Again, calculate the impairment loss of the larger CGU, bigger CGUs, including the value of corporate assets, right? Consider one or two bigger CGUs, very high value CGUs, right? And include the value of CGU into that, right? One CGU or one or more than two CGU, whatever you are reviewing, right? And then again calculate the impairment testing loss. If there is an impairment loss, then entire impairment loss to be gone to corporate asset, because for this is the CGU, we have already done the impairment testing, right? In the step number 1 and 2, we have already done the impairment testing. Now, whatever the impairment is coming, loss is coming, that is only and only relating to the corporate assets, and that is why an entire impairment loss will go to the where? Will go to the this corporate assets, right? So there is a case study. I am just indicating you with the help of answer to save little time. The concept will be clear. Don't worry. So carrying value, there are two CGUs, 20 lakhs and 30 lakhs carrying value, 50 lakhs, then 50 million, sorry. There is an office building, right? There are two CGUs, plant number 1, plant number 2. There is a head office building, office building. The value of that office building is, please see, otherwise you will miss the concept. Question you can ask later also. Allocation of office building is 10 million, which is to be divided, allocated to both the CGUs in the ratio of carrying value 2:3, 4, 6. Carrying value now. What is the revised carrying value of the plant CGUs A and B with allocated allocated value of corporate assets 24, 36, and the total become increased to 60. Recoverable value given 18, 38. Then impairment loss in the CGU, right? There is an impairment loss in the CGUB. There is no impairment loss because recoverable value is more than carrying value. So now the point is, which all people you are trying to understand. CGU under review, I already said. Okay, reply. So now, so there is an impairment loss only for CGU1, and that how to allocate the same. That's the main point of this. Otherwise, it is same as CGU. Now, divided into this is into corporate assets and non-corporate assets, right? Other regular CGU, which is 1 lakh in the ratio of carrying value again. So 1 million to corporate assets and 5 million to CGU, and that 5 million to CGU again will be allocated to individual assets and liabilities, their carrying value, right? If there are 3 assets, divided into 3, 4 assets divided into 4. So that is what is there, and this is the concept. And then is the special concept number 2, goodwill. Goodwill is also exactly the same, right? So then also it is allocated to the CGUs under review. If it is allocated, right, then this is this one, or it cannot be allocated. If it is allocated, then you calculate the impairment loss in the same way, including the allocated portion of goodwill. And but if there is impairment loss, then there is a slight difference. You allocate first the impairment loss entirely to goodwill, because goodwill is what? Goodwill is the this is the fair value of an items, right? Which you this is that which you cannot allocate to any individual assets, right? It is the excess. It is the excess of purchase price paid over the net assets required in a business combination, right? So whatever you can allocate to individual assets during that acquisition process you have done, it is the unallocated value in accounts. You don't want to keep any unallocated value for a long time, right? So whenever there is a this kind of loss surplus are available, they always adjust it against the goodwill input, right? So that's what is the same thing here. Concept is applied. If there is an impairment loss and for a CGU which has a share of goodwill, then first finish the entire share of goodwill. First adjust the entire goodwill, and whatever balance is there, then allocate it to the other assets of the CGU, same in the ratio of carrying value. The same principle is there. And same way is that goodwill cannot be allocated. Same way, first calculate without goodwill, right? As we have done corporate assets, then again calculate it with goodwill. And if there is impairment loss, larger, same concept. What is taking the goodwill to the largest or larger CGUs under review, right? And then if there is again impairment, that entire go to goodwill because that is related to goodwill. For other assets, we have already done the impairment testing. Same principle, right? Now, reversal. Last concept is reversal. And now suppose there is a change, correct? Post-COVID, there is a boom come, right? Possibility is very little. We are going for K-shaped economic recovery, right? But suppose there is a, this is that for the ease of understanding, there is a big recovery. So whatever due to pandemic, market values have gone down. Here, this is that is reversed. That is trend is reversed. Now there is a boom. There is a high increase of this one. Their market value, cash flows increase. So then it is that we have to. This is we can reverse that. The standard allows us the option to reverse the impairment loss, right? And then best example is Maggie, right? Maggie, negative report, sales gone down, impairment, but later on, report found incorrect, sales picked up again, reversal of the impairment loss, right? Best example. Then the reversal, but reversal of goodwill is not allowed, right? Reversal of goodwill is not allowed. Otherwise, that impairment loss of other asset is allowed. And what would be the maximum reversal? So that their carrying value, original carrying value before reversal minus usual depreciation, what would have been the value had there been no impairment? One, lower of the following, or the recoverable amount. Because if you increase again the carrying value more than recoverable value, then again you have to take the impairment. So there is no point increase and then decrease. So maximum in reversal is up to their current recoverable value. The concept is remain the same. Always try to reach the equilibrium. Carrying value should be always is the equal to recoverable value. If the carrying values goes down, recoverable value, impairment, carrying value goes down, this is more than this recoverable value, more than carrying value, increase the carrying value, reverse the loss. So that's the concept, simple concept in words. Then accounting treatment of reversal of impairment loss. It is not the revaluation. Revaluation is separate thing. We have already discussed. It will be a change in estimate. One participant asked, it is not a change in accounting policy, solely prospectively, no need to calculate the retrospective effect. Then, and amount of reversal shall be, entry will be P&L credit or revaluation reserve credit. If there was in the revaluation mode, right, it will be credited to P&L account or revaluation reserve. So disclosures, I am not discussing. Simple disclosures are there, right? That are clear to you. And then there are the difference, applicability, test, financial assets testing, annual impairment testing. We have covered. IND AS 28 was not dealing with this annual impairment testing or the this is that subsidiary and associates and joint ventures and reversal of goodwill. So IND AS 36 prohibits the recognition of reversal, right, of impairment loss for goodwill. But IND AS 28 it was possible with exceptional nature with certain circumstances, right? So these are the three gap differences between the old gap and the new gap. And then practical questions are simple. That is okay. We can consider after the session, and that's the it. So with this little bit extra time, and then we have to manage the time for the next standard. So let's have the question and answer. After that, finishing the important, another very important and very interesting IND AS 105. We also deal with that standard, with a practical point of view, very simple, with a different way, practical manner, so that that concept is already will also clear. And after that, we are free. You can ask me as many as question. I will answer all your questions. Right? Okay. Goodwill cannot be, Sunil, you cannot test the goodwill independently because you do not have the independent cash flows of the goodwill, right? Simple. Okay. So let me quickly share second screen.
Sir, it is visible.
Yeah, Dr. Ajay, you know it very well that this is impairment loss is giving rise to deferred tax implications, and generally impairment loss, right, will give rise to deferred tax assets, and we have to account for those. This is the make the adjustment as per IND AS 12. Right, very well question, very well thought question. Definitely, impairment loss have impact on the deferred tax calculations. Generally, right, it is assets value come down. So that means that is generally give rise to deferred tax assets, right? Which we have to, right? Thank you. Right. So, friends, let's quickly move to another important, very interesting in this. Now, NCA means non-current assets held for sale and discontinued operations. And then is that for the thing, for the sake of brevity, we will always announce NCA for non-current assets and DG for discontinued. This is that discontinued operation disposal groups, right? Now, in this standard, each standard have different feature, different importance. This standard, the most important feature is the recognition, classification. If we understand the recognition criteria, right, well, standard is finished. I am telling you, right? So please focus on this initial 5-10 minutes on this standard, right? You will have an absolute clarity, right? Now, when an asset has to be classified as this is the held for sale, right? Non-current assets and discontinued operation, we will also get very decent clarity. Just wait for a few minutes. Right. Now, entity shall classify a non-current assets or disposable group means a group of non-current assets, like the assets and CGU. So here it is given the name of DG. Right? When you are you have a this is that one assets declared as non-current held for sale, non-current assets. Then you are this is declaring that few assets will be held for sale, are held for sale. Is that the disposable group? And when a full segment, right, full business line is discontinued, right? Business segment is discontinued. That is the same step, one level higher is discontinued operation. Same flute is to be operated with a different, what you say, with a different speed. Lower, medium, one is take assets you are going to sell, non-current assets, right? Group of assets you are going to sell, discontinued, disposable group, and you are going to sell full plant, right? Full factory, full market, one particular product, right? Disinvestment, correct? Then discontinued operation. Same flute is blown at a different velocity, right? Okay. Now, taken act. That's what we are discussing, boss. That's what we are discussing, right? Held for sale. No, it's not on the balance sheet date. Balance sheet date, right? It will be when you decide, right? Okay. Then, so a company can classify a non-current assets held for sale, right? If the if it is decided principally the carrying value of the carrying value, you know, that is carrying value will be recovered, and recovery will be either by selling or by use, right? So now it's saying if it is decided to recover the carrying value of an asset only principally through sale and rather than use. That means, right, that management has declared, we have seen that only the selling method apply, that we will recover the value of these assets by selling the assets, not by using the asset in the business. So once we have decided, taken that decision, then that then that is that assets will be classified as held for. Right now, example. Naturally, we are understanding the standard only with the example and case study. Definitely, we will do that. Now, see, a company want to sell one of its factory buildings, small factory, right? Then, because it has shifted the operations to a bigger building, bigger plant, then it is a example of factory building, old factory building. What happened? It will be reclassified as held for sale because management has decided to not to use it. Now they have taken a new plant, new factory, bigger factory, and now it is lying in your balance sheet as a held for sale, and management will in the future will willing to sell it as soon as possible. Consider another example, right? Then another factory want to sell one of this small factory, same case situation. But here the difference is that it is along with few old machines also, right? That becomes what? Old when it sell, it becomes a group of NCA, and group of NCA means it becomes a DG, disposable group, right? And the point is that, main point is that, please focus. That this is the point is that these assets were financed by a bank, right? And still the EMI is continuing. There is an associated liability, right, attached with that, correct? And that is current associated with current assets and current liabilities, correct? Now, because it shifted the operations, right, and they are planning to sell this factory, this disposable group was building as well as certain machines together. So along with the assets and liabilities, right? Sorry. Then that will become a disposable group. So that's the difference between the non-current assets and the disposable. Clear? One minute. Thank you. So clear? Now, condition for classification. Condition for classification, indicator for classification. In 36, IND AS 36, we use the word indicator for impairment. Here we are using for condition for classification. Same thing. So there are two essential conditions. There are two essential conditions. Both of them must have to be satisfied if for classification into held for sale criteria. Condition number one is the asset must be available for immediate sale in its present condition and subject to usual terms and conditions. Right? Correct? These three things. Condition two will be highly probable. Sale is highly probable. Right? And then what is the meaning? Let's understand with some practical cases. Now, there is one case study given at the bottom of your screen. Try to address that. Only 30 seconds is the time because time is limited. So, a company has decided to sell the current office building. therefore wants to classify the same as held for sale. But one of the main conditions is that possession will be given only after new office is created, new office building is created after 2 years. So please advise, right? You are the consultant. Your HFS, yes or no? Very good. 100% clarity, top class clarity, absolutely no doubt clarity. Because it is not available in the present condition, not immediately available, right? 2 years, which buyer will give you the cash for the asset, which possession will be taken after 2 years? No. So you cannot, if you do it, that means you are doing as a profit adjustment, window dressing. You are tampering your accounts. You are using it as a tool for your profit adjustment. Standard is very strict. It has created after a lot of research. So it knows how it can be misused. No, clearly ruled out. Boss, you cannot do it. Sorry. Sorry. Right. So that's the concept. Right. Okay. Now, condition 2. Sale must be highly probable. Okay, all attached with case study, absolutely full clarity will be there. So highly probable means 5 sub conditions. Highly probable to satisfy the main condition, highly probable, 5 sub conditions, all 5 to be attempted, right? 1, sub condition 1, the appropriate level of management must be committed to sell or plan to sell the assets or DG. It's not that that is tomorrow one worker will come and say, I don't like this old machine, right? It is making too noise. I want a new machine. So you will be classifying it as a non-current held for sale, right? No, correct. No? So then it is the first study. A worker demand. He doesn't like the machine. And he can say, nah, give me a new machine, right? Samsung is working in LG and say Samsung has a better machine. You also bring me the same machine. Can he say do so? No, right? So now, second, there should be an active plan, right, to locate a buyer, and the plan must be implemented. It's not only a plan. Plan is plan. Okay, in one of the board meeting, directors discussed on a cup of tea, right, like a Sunday morning. They're in a resort, off-site meeting. They discuss, or this is what, gentlemen, what do you feel that? See, we have a existing machine, little old, and now there are higher variant of that machine available. Should we sell that machine and replace with a new machine? So which is it a, then what do? The accounts manager will change the classification, right? Yes, no. No, 100%. Devendra Kurana, Agrima, right? Everybody, Sampath, Richa Gupta, 100% right. No, right? That is the right answer. And no action taken on within 6 months. Absolutely no logic. Then price quoted is reasonable in relation to the current fair value of the assets or DG. Right. Now suppose a company is asking 30% more market price in this pandemic. Right. Correct. And to repair the old past recover. Will it be right? Rajesh? No. Correct. Nitesh? No. Nothing. You are declaring, you are just making an misrepresentation. Try to show your unintention, right? You don't have any intention to sell the machine. You are just trying to bring the time pass, or might be trying to, this is the misguide your investors, right? That we are declaring. Because non-current assets DG has a very wide profitability impact, correct? And the financial position impact. It can be used as a deadly, in a deadly way. Standard says, no, 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 no. You don't have any intention. I will not allow you. Okay. Sale should be expected to be completed within 1 year. See all how delicately, how intelligently, how smartly the standard is pitching up one after one condition, right? So that standard is not misused. Okay. The sale is expected to complete within next 1 year. 12 months में बहुत बेचना है, right? Then the board have decided to sell old machine at scrap value, and company has given an advertisement to invite bids. Will it be NCA for sale? Read the question carefully. Right. Anup Singhal, very good. Devendra Khurana, right answer. Right. Please see here, the plan is there, board of director, right? The appropriate level of management has decided. There should be an active plan, right? The plan is there because, and that plan should be implemented. They have already given the advertisement also, and the conditions are normal condition. They are selling it at scrap value, right? So then that is plan is implemented. So that is why that is held for classification. Here you can do the held for classification, right? And this is it is highly probable. Correct, Shubham. Very good answer, because it is assumed you are working. You have decided. Management has decided, right? They implemented the plan. They have given the advertisement much lower than that scrap value, right? Did that. So there's that. In this situation, the sale is highly probable to complete in 12 months, right? So that's the thing. And last is, it is unlikely that significant change in the plan will be made, right? And it is no reversal of the plan. Right? It's highly unlikely that after giving the advertisement, you withdraw the advertisement and say we are not declaring selling. It is highly improbable, right? So that's the thing. So Kirti, Rajesh, which this is and Mansi. Good. Understanding is right. Okay. Now, so exceptions. Now I am covering the exception very clearly because paucity of the time, but I will deliver you the concept. Don't worry. There are few situations is that in which, correct, even though the conditions, this is it is not this is it is sale is not even though that the sale time is extended, it is that sale is not expected to complete within 12 months of the date of classification, right? Date of classification. Even then, we continue to hold the held for classification. Sorry, held for sale classification. We don't change. What are the condition? Now, suppose, right? You got a commitment. Now, in this case, machine, you given the advertisement. One buyer come. He has this is the given the order, right? Okay, I am trying to purchase. This is giving you the order to purchase it. But later on, when his engineer visited the machine and then he found a much bigger defect, right? Or it does not conform to the pollution norm. And then he intimated to his person, right? And then he says, that is okay. Now, boss, and then buyer refuse. Buyer say, boss, unless you get me the latest pollution certificate or unless you rectify this major defect, I am not going to buy. Otherwise, it will be a liability. It will be a fine for me. And then, but company also accepted and necessary action taken. Necessary action taken. And then they are doing the major repair, necessary repair, and they apply for the pollution certificate. But then it will take 2-3 months extra, and instead of 12 months, the sale will be completing 15 months. The standard said that is reasonable because it is showing your intention. It is showing your intention that you are still very well intended to sell the machine. Circumstances become like that, and you are addressing the circumstances so that you don't need to change that thing. Very logical standard, right? I appreciate. So in that situation, and in another similar situation, is that the same thing? Is that okay? Is that pandemic case, right? You before pandemic, you agreed to sell the building 1 lakh. Now pandemic, market value go down. Buyer says, I will purchase it only 70,000. If you want to sell it. Otherwise, cancel the agreement. And you have full intention to sell. And you also understand now all the market value will getting down. You cannot sell it at 1 lakh. You agreed at 70,000. In that situation also, they say, okay, you can continue to show the asset as held for sale, no matter that it will take some extra time. So these are the few exceptions, right, that is allowed. Otherwise, very strict standard. Now, few important points, very quick, very important points. Right? Assets out of active use, no held for sale classification. You are today not using, right? Tomorrow you use the machine because you have the order of that machine. That does not mean you are intending for sale, right? So out of active use, no criteria, right? Abundant assets, right? Abundant assets, even though you are not using it, but you have not taken a decision. You have not taken an action plan. You have not implemented the plan which your firm intended to sell it within 12 months. So no classification, right? Not allowed, right? Then depreciation after HFS classification. Depreciation is what? Normal wear and tear due to use of the assets. If you have reclassified, you have declared your intention of selling, then there is no use, right? There is no active use, no depreciation. If you are not using the assets, then what for depreciation, right? Logical point. But you have to test it. Now, suppose this held for sale decision is taken at the, 1 month or 2 months before the closing date. So naturally, on the closing date, you have 12 months. You cannot expect sale immediately. So on the closing date, you have to test it for this is that impairment, right? Because that is in 2 months. What is the fall? If there is a fall in the recoverable value from the carrying value, you have to put the impairment loss, but that loss will be booked under 105, not under 36. Because we discussed this is a full-fledged standard, deals with non-current assets. So recognition, measurement, disposal, disclosure, everything will be as per this standard, not as per another standard. Logical. Right. HFS classification is met after reporting period, non-adjusting event. Right. You will not adjust the this is the closing balances of the balance sheet, already closing date. It will be now shown in the next. So now the measurement very quickly, 5 minutes only. Right. Measurement is that NCA DG. That is what. Please see the yellow highlight. Only this is whose valuation is not governed by their principal applicable IND AS. So this measurement criteria will be applicable only to those non-current assets and DG for which there is no separate independent AS is applicable. And if yes, then simple. What is the valuation? Valuation, we have only two norms: historical cost and the fair market value revaluation model, right? If you follow that, and that is why the measurement of the NCA will be the same way, right? On the date of classification, carrying amount, right? Or the fair value. That means there. So that is a fair value cost to sell. So that is the two-way, lower of the two, because historical cost is low. Naturally, recoverable value is higher. No need to impair, right? So fair value and the carrying amount is fully. This is that there you right valuation. If fair value down, carrying value is more, immediately the impairment will be applicable. Come down, balance with the match with the fair value, and then that will be the valuation. That is what they say is that if an asset or DG is acquired as part of the business combination subsidiary, right, right, or for sale, or any other assets, individual assets, few assets, and that satisfy the HFS criteria. In that asset, what is the use of historical cost? What is the use of cost method? Nothing, because in business combination, all asset assets will be acquired at fair value, right? So in that case, no need to extra work. You deal with the fair value. So that is the concept. Then we already agree no depreciation after the change classification, HFS classification. But why I repeat it here? There is an important point left, the last slide. Interest and other expenses attributable to the liabilities of the disposable group or asset, that will continue. It does not mean that you got a right that okay, you wanted to sell the machine or some building, right? Correct, and some vehicle, and today, which and that gives a right to discontinue the EMI to the banks. Oh, then very happy. No, sorry, right? So the liabilities and expenses, interest and other expenses, that will be applicable, that you continue to incur. Correct. So that is the case. And then impairment loss, NCA and DG will go to P&L. Same concept, prudent concept. Impairment loss means immediately P&L. Nothing, no OCI, right? It has to go straight away to P&L. And P&L only thing is that continuing operations. And why continuing operation? Because you are selling a single asset, boss. You are selling only one or two non-value added assets. Nobody will sell the this is the running plant. Nobody will sell a major assets. Nobody will sell a significant assets that will amount to disposal. Discontinued operations. Correct. So that is why is that measure. This is loss or impairment loss or profit or loss, right? On sale of the a single asset or a group of assets will be shown in the continuing operation as part of the profit and loss as continuing operations, and it will not go. It is not because from selling these assets, the business is not going to be impacted. It will run as business as usual, right? And sometimes it is better to sell that as scrap assets and clear the space, and it will save the cost of holding those scrap assets. That's the point. Measurement. And what about the same thing? What about the measurement of those NCA and DG whose for whom there is an independent IND AS available? That will be defined by that in that standard. Now deferred tax asset, you cannot define the fair value of deferred tax or fair value of deferred tax liability. That will be calculated in the usual manner, tax base, carrying value, tax base, temporarily deductible difference, temporarily taxable difference. That is the same way. Whatever this is that recognition, measurement, disposal, adjustment, revaluation that will deal with this. That is that respective standard. What are those standards? In IND AS 12, deferred tax, 19, employee benefit, 109, financial instrument, agricultural, 41, insurance, 104. So in those cases, how that is to this non-current assets has to be in sync. Provisions of those standards and this 105, how it is to be done. They say, right, that in those case first value these assets as per their principal applicable standard, right? Value these assets as per their main standards, and then after that apply the this is the recognition criteria. You have done, and that has nothing to do with the recognition criteria. Valuation in this case has nothing to do with the valuation. Recognition criteria. You define the valuation as per this standard or any other standard. After that, if you have intention to sell it as per those conditions, two conditions and sub conditions, classify it as a non-current assets or DG, right? Examples I have already explained: direct deferred tax asset and financial instrument, amortized cost, present value OCI, right? And all these things. So that has nothing to do. Value as per that, amortized cost, and then apply the criteria, right? And P&L again continuing operation, because selling these few assets will not going to impact your business. Change in the plan, same thing. If there is a change in the plan, right? Because and then that is what we said. So management suddenly, that is the situation changed drastically, Maggie, right? So now there is nothing to be sold, right? All the production line of Maggie not to be sold, now to be retained. So reverse this is reclassify, not reverse, sorry, reclassify. Now the assets will no longer be assets held for sale. It will be reclassified as usual business assets. And measurement, naturally, you have to remeasure because you are changing the classification. Then same thing, carrying value before the classification. And if there would be no classification held for sale, usual depreciation, usual impairment loss, and arrive at the current date value. So this is the carrying value, which should be had there been no reclassification done, or recoverable value. Same recoverable value up to the maximum recoverable value. If you increase the value of the assets, right, more than recoverable value, again impairment. So same thing, balance has to be kept. So that's the lower of the two, and recoverable, same thing, and profit or loss of reclassification, again P&L, realized loss, or this one, and then this profit, and then is to go on to continuing operation only. Now presentation pretty simple, that we will do with the help of
How much time will it more take? We'll wind up. Sir, अभी और कितनी देर और लेंगे सर? थोड़ा सा.
Hello, few minutes more, madam.
Sir, because I think we have some question answers also to be taken.
Correct. We will take one question. We'll take two on this thing, and then now discontinued operation. Simple. Discontinued operation is what we have already said, that you are discontinuing a full set of operations, right? A separate major line of business, a geographical area of operation. Now you suppose that you will not sell your product in the South India, right? Okay, so that is a what? Discontinuance of operation, right? So you are producing 5 products. You declare, I will not produce 1 product, right? It is what? Discontinuing of operations. But the thing is that that should be part of a single coordinated plan. It's not that in piecemeal you are selling one by one assets and then you are saying it's a discontinued operation. No, as a part of single operating coordinated plan, or a subsidiary, you acquire a subsidiary, right, and exclusively with a view to receive. So that's a discontinued operations. But discontinued operations, disclosures are separate, right? Discontinued operations, we have to show P&L separately as well as the balance sheet separately, and we can see is with the help of a case study, right? It is a real balance sheet of a big company, right, which has converted its old standards into IND AS, right, in the first stage, right, in the 2016 onwards itself. Now, so that is what is this given. Now you see, first point, what we have discussed, impairment of goodwill and other non-current assets. So the profit and loss on the impairment or the measurement, right, remeasurement of the non-current assets and disposable group. It are shown in the regular items, right? Continuing operations, right? Can you notice this, right? Note number 3 and 5, 2100. Okay, then, but discontinued operations are shown separately, right? That's the first point. Then is even in the balance sheet also, right? In the balance sheet, this is all the held for sale assets, all in non-current assets, and DG, which are held for sale, are to be shown separately. Last line, assets qualified as held for sale. Then, and including the individual property level also, that is in the PPE. It was the overall basis fixed asset schedule, but in the PPE also they have sold assets included in disposable group held for sale separately. So it is to be shown separately. Depreciation also to be shown separately, both the arrows. And then discontinued operation. Discontinued operations, right? It is a subsidiary. There was a German subsidiary. This is the balance sheet is 2017 and 16. On 30th March, one day before the closing date, they decided to sell this German subsidiary. So, right? So that is how immediately on 31st March 16, that has to be shown as discontinued operation. A subsidiary was sold in May 2016, and that is why that in 2017 only 2 months operations profit and profit and loss are shown, and 31st March 2016, right, it is the balance sheet are restated for, that is for discontinued operation. and then details of the subsidiary, right? That is given. All this is there. This is the, and then the detailed, this is our notes are given that following assets and liability were reclassified as held for sale for in relation to discontinued operation 31st March. So how that assets were classified, reclassified, and this is for the reclassification of the assets and liabilities which are here, and there is a detailed calculation notes for this and with the commentary. So with this, this is the end of the session of this, and then we can cover all your question answers. Right, Anjali madam, we can come to the question answer mode, and then now it is floor is open. You can ask as many as questions one by one. I am happy to answer.
Sir, you can take up the questions from the box, or you want me to read them out for you, sir?
I am coming to the box.
Okay, sir. Because there are some common questions, so आप एक answer करके then we can skip all others.
Yes.
जी,
What
sir.
is the basic difference between first answer Deepika Bansal? What is the basic difference between revaluation impaired? Because we have answered, right? I think we have answered this very clearly. Revaluation is the yearly accounting process, like yearly depreciation process, correct? So instead of this, in the cost model, we do not change the carrying value. That is the value of the assets. Historical cost is continued. Only we have to calculate the depreciation. But in revaluation model, we see whether the value of the assets is changed or not before providing the depreciation, and if there is a change in the value, we change the value and then provide the depreciation. And revaluation model is also, is not compulsorily every year, right? Because it is for volatile assets only. Otherwise, for non-volatile assets, 3 to 5 years, once in a while you can change the revaluation. But impairment is on indication based, right? And it is extra above the revaluation. Okay, so that we have answered. And then lower selling price, I could not get this. How carrying value is recoverable value, right? And if then it is less than the recoverable value. I did not get an answer, Himanshu. What is the question you are trying to ask? I think what we have asked and explained in the example as well, right? Then CA Amit Gupta, okay, is measurement of impairment mandatory? Measurement of impairment mandatory in accounting period? No, that's what we discussed. If there are indicators, then definitely, unless the case fall in the three cases, intangible assets and goodwill, where annual impairment is required. Except barring these three conditions, three types of assets, right? There is impairment measurement testing is not mandatory in each accounting, right?
I think Subhash sir has raised his hand. He wants Subhash Pandey sir. I think he has a question or something. Sir, you can put it in your chat, sir. You have
Okay.
raised your hand.
Okay, we can unmute him also and he can speak to me. Okay, coming to chat box. Okay, right. Which is the question, madam? Can you help me in finding? Dr. Yogesh Shukla.
Subhash sir, you can ask your question in the chat box, and Himanshu has also raised his hand. He has put up his question in the chat box that I could not understand why residual value is not
I will
deducted.
cover. I have explained 2-3 times, but he is not. I think he is not able to understand. So I
Sir,
am giving
then,
it.
sir, it is more or less the common questions can be answered. The rest, after once the sessions are over, we'll be
Yes, that's what I'm
sharing
saying. So this
huh.
will answer at the end. Let's consider more difficult ones, and it's a very easy question. And only I have to see how in other way I could make him understand. Right? So let's consider the other questions first.
I think, sir, simultaneously most of the questions are being answered by you.
Correct.
Any last minute one or two questions? I request the participants. Sir is with us for another 1 or 2 minutes. Any last minute questions that you think have not been answered, you can put up last in the Q&A box. Sir will take up that question. Otherwise, we'll wind up the session.
Okay,
Two
but
participants.
Anjali madam, one or two
Ji.
candidates are still saying, but let us answer now. What is this thing? We can
If
spend.
you want, I'll allow Subhash sir to talk.
Yes.
I've just.
And this Nand Taneja, I would
Uh,
also answer Himanshu also. Nobody should go with any doubt. Right.
Sir, I have, he can ask his questions. I have unmuted him.
Yes. You can ask Subhash sir. Hello. Have you unmuted Anjali madam?
I have done it and I've asked him to unmute. So we can, I think maybe
No,
he's
no,
having that way.
no, sir. I don't have any questions generally. I have.
Okay. Sir, it's just that you have raised your hand. That's why we were
Actually,
just.
that was
It doesn't make a
wrongly.
difference. Thank you,
That
sir.
was wrongly put up.
Thank you.
Acha,
Thank you.
acha, okay. Okay.
Okay, sir.
So, okay, the only last two question I want to take. Okay, one is that Himanshu. Himanshu, see, in that situation, this is carrying value is what? Right. Carrying value is that, okay, leave that, okay. Don't understand in that way. Let us understand is that is how, if a value, the same example, if your asset, you purchased an asset 10 lakh rupees, right? You depreciate it for 2 years. Now you have a value 6 lakh rupees, right? In the carrying value. How that value can be recovered, right? You are showing, and that is you are showing that value as an asset, right? If you are showing an asset in your balance sheet, then what is the meaning of that asset, right? How it can be that assets that is, and why it should be 6 lakhs, correct? Why not this is the 7 lakh or 8 lakh? Because that you believe that asset worth is 6 lakh, and asset worth of 6 lakh is the recoverable value. And there are two methods of recovering that value, right? Either through use, either you recover that 6 lakh benefit out of that assets, either through use in the business by getting the sale and the cash flow, or selling it in the market. So that is what it is said. The carrying this is the recoverable value. Then is that you have to compare, and we are not saying that carrying value is the same as recoverable value. We are saying we are comparing the same, estimated. What is your carrying value that you are expected to recover from the sale or use of the assets? But if you feel that this is, and if it is found that recoverable value is not the right, is not the carrying value equal to carrying value, then that means you have to adjust your carrying value, because as per the standard, as per the gap, as per the accounting principle, you cannot show any asset value of an asset which is lesser than, which is more than the recoverable value. Okay, I think with this you can understand. And any other question? I think everything we have done, and no problem. Hello, Anjali madam. Hello, hello,
जी
Anjali
सर
madam.
जी सर बताइए
Yeah, please, whatever that people who are not finding their answered question, you circulate those questions to me. I will be happy to answer. Right?
sir at the end of the FDP we have a practice to circulate the email IDs of a resource person to the participants so they can in future clear their doubts or get
Correct.
some.
So I think, friends, because the organizers are not are also under their protocol, we have to end the session. But I am open. You can reach out to me through the this is the organizing organizers, and then you can mail all your questions to me. I will answer each and every question. Right?
Thank you, sir.
Uh,
Thank you, sir. We are thankful, sir, to CA Manish Goyal, sir, for this session on Ind AS 36 and 105. Thank you, Anshika, for taking over when I just lost my connection for a second here. So thank you very much, sir. It was really a very knowledge-packed session that it was there. And at that same time, I just take this platform to really appreciate the way you have explained each and every intricacy of the accounting standard. Really a lot of changes have been happening, and for professionals to keep themselves updated regarding all that they are adhering each and every accounting standard, this thing or understanding of these accounting standards is really very important for them. Thank you, sir, for joining us here. We are here, and once again I just take this opportunity to show my gratitude to you from on behalf of the Indian Accounting Association NCR chapter, as well as on behalf of TLC Ramanujan College, my whole team, which is there with me, Dr. Anshika Agarwal, Dr. Purushottam Kumar Arya, and Miss Charu. Thank you, sir, for being here. And in absentia, our main mentors, Dr. Joel Gupta and Dr. Rekha Dayal. Thank you, sir, for being there with us. Thank you.
Thank you, madam, and thank you to all and all the participants and for such a good session. Thank you very much. Have a good day and
Thank you, sir.
thank you.
Thank you.
Thank you,
Thank
sir.
you, ma'am.
With this, we come to the end of the session today. And we are meeting on next Saturday. By that time, I think you'll get the recordings and everything will be there in your emails by Monday evening with you. And at the same time, what I request, we'll be ready with one more assessment that will be coming up or to your side maybe by Monday in your email. Anything that questions you have, it is my request you drop your messages in WhatsApp, in any of the organizing teams contact details that are there with you, and the queries will be answered. Thank you, sir. Thank you.
Thank you.
I request Dr. Purushottam to end the session.